So we now go to deferred consideration. That is what we'll be looking at. Welcome to the Coach Cutters Academy. So in the previous lecture, we looked at share exchange. That is what we looked at. And we found that the principles were very, very easy. What we did in the share exchange or share exchange, where the would-be parent company or the company that is eventually going to become the parent company dangles a carrot to the company that is going to become a subsidiary company. Says, I want to buy some shares from you, majority shares. But I'm not going to use cash to buy those shares. Instead, I'll give you a stake in my company. But this is how we're going to do it. For every share I give you, you give me 4 shares from your company. And my share is valued at 4 kwacha per share. But I want 80% of your shares. So from the 80% of the shares, if, for example, in the example that we looked at, there were 20 million shares. The subsidiary company had 20 million shares. And this would be parent company, because it hasn't become a parent company yet until the deal is finalized. The would-be parent company comes in and says, I'm going to buy 80% of the shares from your company. Agreed, agreed, yes. So 80% of the shares, 80% of the 20 million available shares in the would-be subsidiary company, it was 16 million shares. So that's the first part. First, you know that these are the shares that I'm getting. But then, again, because there's a sweetener to that particular deal, it says, no. My company, as a would-be parent company, is doing fine. It would be nice to come and work with me. It would be nice for you to have a stake of this particular company. So what should we do? I'm offering you, for every share I give you, you give me 4. Since the 80% of these shares is actually 16 million, meaning that I'm going to offer you 4 million shares in my company for me to get 16 million of your shares. So that is done because it's 1 to 4 million shares. But I say I'm going to value it at my fair value, which is 4 million. It takes now to 16 million shares. To 16 million kwacha, sorry. So the cost of that investment in the subsidiary is 16 million kwacha. But then the double entry is very easy. We know that an investment is an asset. It actually sits on the first half of the balance sheet. So any increase in assets is debited. Any decrease in assets is credited. But since we're actually investing, it is increasing our first part of our balance sheet. So we are debiting the cost of investment. But in finance, or in accounting, sorry, not in finance, in accounting, there will always be 2 legs for it to balance. There will always be the debit and the credit. So on the credit side, let's say if it's 4 million shares at the par value of 1 kwacha per share, it actually takes, what we are going to credit will be 4 million kwacha. The difference goes to the share premium, which is 12 million kwacha. Or you can still say the fair value of those shares, which was 4 kwacha, less at par value, it gives the premium value of 3 kwacha per share. So which will be 3 kwacha times 4 million shares, it goes to 12 million kwacha. And that is how it balances in terms of the double entry. Now we proceed to deferred consideration. The concept, Sidney and many others, the viewers here, the concept is basic as well. The concept is that you do not have the money. You do not have the money. So what you do, you say whatever amount that the deal, for the deal, whatever amount for the purchase amount, you have agreed that it's going to be paid at the end of the year, or the second year, or the third year. But then decisions have to be made now so that we factor it in our financials. It has to be discounted today. But most of these deals, they are actually hybrid. There will be a share of exchange, and there will also be the deferred consideration. Now we can formally go to the presentation. So on deferred consideration, they are saying a parent may agree to pay cash in the future following the acquisition of the subsidiary. This deferred consideration is recorded on acquisition at present value. Like we have said, it has to respect time value of money. It has to respect time value of money. So when you are given a...
I'm interested to see how this is going to unfold, the Congole.
Eh?
I'm interested to see how this deferred is unfolding.
Yeah.
Congole.
The Congole, oh yeah. And you see in finance, anything that is deferred, when you're talking about payments, you have to bring it today because you're making decisions now. So whoever the subsidiary is not going to say, oh, we'll be given 10,000 after 2 years cash. It doesn't end there. Because the subsidiary or the would-be subsidiary wants to make a decision today. So it is prudent for the subsidiary to compute the present value for that future cash flow. What is the present value for that future cash flow? So the principles are just logical, extremely logical. There's nothing to master. So here is the example. It reads, Ponga acquired 80% of the 40 million 1 kwacha acquired shares of Stumbeko. On 1st January 2020, the consideration was through the offer of a share exchange of 2 shares issued for every 3 shares acquired. That's the first deal. Let me do this. So you have to understand these things nicely. The first deal was on this part. This was the first deal. Sorry, I haven't marked it nicely. Let me do it. So the first deal was on this. And a cash payment of 1 kwacha per share. So what I want you to do, I'll give you about 5 minutes. I want you to compute the first part of the share exchange. Then now we'll go to deferred consideration together. So just take a screenshot, and do it. Because there's this first part, then there's the other part, which is this. This is what we'll be looking at.
Hello? Yes, boss. Then 2 to 3 shares, then this other one we don't know, then it, again it's 32. So I did what you did, 2 times 32, which is 64 over 3. Yeah, so I came to discover, I found it was around 21,300 shares
Okay.
in terms of.
Yeah, I'm sure you got it. Let's do it together. Let's do it together. So let me just go to our whiteboard. So we are saying there are how many shares? There are 40 million shares, right?
Yes.
In the subsidiary.
Sure.
So with the 40 million shares, all we are interested in was what percentage? 80%.
Yes.
So 40 times 80%, it should be 32 million shares, right?
Yes.
Now we have 32 million shares. From these 32 million shares, we have been told about the share exchange. Every 2 shares, the parent company or the would-be parent companies, the subsidiary or the would-be subsidiary company is going to give out away how many shares?
3.
3 shares. And this 32 million sits just here on the subsidiary because this is the subsidiary, this is the parent company.
Yeah.
Giving you, if you do like this, giving you 32 times 2 over 3. How many shares?
32.
Which will be 64 divided by 3.
Yeah. 20. 21,333.
21,333 million,
Yes.
isn't it?
Yes.
It's basically million. It's 21,033 whatever.
Yeah.
So in short, it's 21. Let me just do this. Do it right. So it's 21.3 million. So then we multiply by the fair value of the shares, the parent company, how much are they valuing their shares? How much are the shares being valued? The fair value of the Ponga's equity shares is 2 kwacha.
Yes.
So giving amount of how much?
42,666. 42,666.
So it's 42,666 million.
Yes.
Right? So from there, then we know that this is the first part. When we are looking at the consideration, which we'll have to take to working 3, where we'll have to compute goodwill. We'll have the first part, which is the share exchange. Which is 42, how much?
42,666.
So which is 42.66. So the thing now that we are remaining with is only deferred consideration. So we go to the computation there. So we go to the computation. First, we need to understand one thing. What was the 80% of 40 million? Is 32 this 32 million?
Yes.
So we'll have that 32 million times at par value, which gives us how much?
Par value was 1 quarter.
Yes. So we'll have 32 million shares
times 1 quarter.
Times 1 quarter. Times 1 quarter. This is basically at par. Which then gives us
32 million quarter.
32 million quarter. But then, when do we expect this? This is the future cash flow.
Yes.
So at the hurdle rate of 10% is times the discount factor of 0.91. So in short, it is just 1 divided by 1.1 in year 1. That is the number that you're going to put here.
How do you come to that one?
To
1/1.1.
The discount rate is 10%. That's the discount factor, or what you may call as a hurdle rate.
Oh, okay.
So in year 1, it is 1 divided by 1.1. In year 2, if it was in year 2, when you expect that amount, it would be 1.1 to the power 2.
Oh, okay.
So meaning that if you are to discount this 2 million kwacha that you expect to receive at the end of the year, if you are to discount it to today, you want to know how much it is today. That will be how much?
It's 2.
And so then now we are saying to today, how much would be the deferred consideration? 32 million times 0.91, blah, 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 blah. I'm sure you have your you have your calculator there, which is 1 divided by 1.1 times 32 million. How much are you getting? You are mute, you're on mute, you're on mute. I can get you.
I'm getting 26.427. 26.472.
26.472.
472.
Okay, I'll just say 26.47 million. So this is what we will take this side. So this is what we'll take this side. 46.72.
0.47.
0.47, sorry. Okay, let me just. .47. So the total amount would be how much?
It's coming to 26, coach.
Yeah?
It's 26.47.
Oh, 26, not 47.
No.
Oh, okay.
26.47.
So giving us a total consideration of how much?
About 53.13.
53.13. So that is how you do it. I don't know if you have understood the concept. Can you just do a storytelling to me? I just want to hear from you. If you had to do a story on this, how would you tell this story?
I think the only issue is on a deferred consideration here, where you need to take into account the discount value and also the percentage to bring the future cash flow, you know. So what we did was we got the 32 million shares, which is at par, times 1 kwacha, it gave us 32 million. So this 32 million kwacha should be multiplied by the discounting factor, which is 0.91, then multiplied by 10%. That's how we find the deferred consideration. So you get the share exchange plus the deferred consideration, it gives you 53.1. Yeah.
Thank you so much. So if it was in year 2 or the same, you have to use the discount factor for year 2 or discount the future cash flows to today, so that you make a decision and you factor it in your goodwill computation.
Yeah.
Interesting, isn't it?
Sure. You know, we were just fearing this because even what they ask just when they are doing this, it's not like in the many questions. They just ask small things, you know. Yeah. So that's writing stories.
The whole issue here is basically, it's like I always say, it's just logic. It is just logic. That is what is there. So as we move on, there are also stages here. On the deferred consideration, it will need to be unwound to its final value, and done so using the interest rate originally applied to discount back the original entry and recorded as follows. So you take it back, where now you debit the finance cost by using that same rate, and you credit the deferred consideration. But all these adjustments, they do not impact the fair value consideration. As we start looking at exam type questions, I know we'll have to do it next week before you start writing exams. Just some components, and you'll see how it is actually done. It is truly basic. Yeah. So from here, we consider this topic on group financial position or group balance sheets to be done. We'll then now go to the P&L. The P&L, there isn't so much in there. It's basically on the PAP. How do you adjust the PAP, the logic behind the PAP? Then once we are done with the group profit and loss, hopefully even tomorrow, not hopefully, tomorrow, even tonight, we can go on and look at the associates.
Tonight to be fine.
Yes, we can look at the associates. So before we go to the group profits and loss, I would want you, I've sent a link and the presentation on IFRS 36 on the impairments. I would want you to go through it even for about 45 minutes, then we'll go back. You have to tell me what are the pinpoints and the penny points, things that you have found may be a bit tricky on IFRS 36. I'll explain it. It's just in my head in here because I model IFRS 36. So I'll explain every component that you would want to know under IFRS 36. Then now we can proceed to group profit and loss so that we finalize that. So as we are doing that, I'll have to upload these two lectures that we have looked at today on YouTube just about now. So I close I'll close my thing. Then you can just go to IFRS 36. So that once you are done with that, then we'll go into group profit and loss. Once we are done, again, I'll give you another standard you should look at, and I'll explain it later.
Okay, sir.
Yeah, so thank you so much. But what before we go, you have to check out, and you know the rules of checking out.
Yes, I think the take home are two things today. The share for exchange and also the deferred consideration. But there was also a contingent one, which is similar to the deferred consideration. So for share exchange, I don't think to have a problem. This is fantastic. But the deferred consideration, the tricky part is where you have to do the share exchange, and those discounting factors, multiplying by the percentage given, like 10% in this case. That is where I need to concentrate more because that's like more detailed, different from the share for exchange. Yeah.
Now let me explain on this one. It's just that question we looked at the example, it was a hybrid. It had two things. That the first component, which we had already looked at on the share exchange, then it had the deferred consideration. The component of deferred consideration is very easy. If I say, for example, I'm buying 60% of 100 million shares in Yahoo, for example. 60% of 100 million shares in Yahoo. It means that I'll need to get how many shares? I'll need to get 60 million shares.
Yes.
But the 60 million shares, I have to check at par value, how much is a share? At par value, because at par value, that is what is the balance sheet anyway. So at par value, which is say 1 kwacha per share. So to be 1 kwacha times 60 million shares. So to take me to 60 million kwacha. But do I have the money to pay now for this acquisition? No, I don't have. So I've negotiated with Yahoo board of directors or Yahoo shareholders that I'll only be able to pay at the end of the year at a discount rate of 10%, 8%, 12%, whichever is prevailing. And you need to understand that even when you're looking at these discount rates, they are coming in, there are certain factors that you have to look at. You have to look at what's the beta there. You have to look at the whole capital asset pricing model. You have to go on to also look at the weighted average cost. You have to look at the debt equity for the whole industry. So there are a number of factors that you look at in coming up with that hurdle rate of 10%. So now in the exam, obviously you don't need to look at those things, but in the industry, as who model these financial accounting standards, we normally look at all those details. So you have a 10%, and you know that 10% in the first year is 1 divided by 1.1. In the second year is 1 divided by 1.1 to the power 2, and goes on like that.
Yes.
So the discount rate, the discount factor for 10% in year 1 will be 0.901, which then now I'll use that number, actually 0.909, taking it to 0.91. So I'll use that number times the 60 million kwacha to discount that future cash flow that I expect at the end of the year to today. So even the deferred consideration sitting and the viewers out there is also a basic thing. It's just that that example, we combined the share of share exchange and the deferred consideration. Thank you so much. See you in the next class. Bye-bye.
Thank you. Bye.